Oftentimes those, particularly with development deals, it's all based on a optimistic scenario of continued rent growth and economic growth. And as you know, real estate is so dependent on employment trends, on economic growth, obviously supply side factors as well. And a lot of those deals ended up not performing well at all for the bank. One of the lessons we learned as we grew our business at Paladin, and we were joint venturing with, we act like we're an operator in many of our sectors, but we were also providing joint venture equity to third-party operators. Having skin in the game, having a sponsor who has real skin in the game is critical. And none of the developers that we were financing when I was at the bank really had skin in the game. Even that doesn't work because a lot of real estate developers have lost a lot of their own money. So skin in the game alone won't work. And to really understand the cyclical nature of real estate and how different markets and different sectors will weather, how resilient they are during market cycles. That's something I was way too green in the 80s to understand that. Most lenders should be relatively risk averse. That's why you're a lender. That's why you shouldn't be lending 100% of the construction. And we were lending 120% of the construction at that time. So, it was a time where it was, I think, relatively early in a 30-year wave of liquidity that was fueling all kinds of business opportunities, not the least of which was real estate. And you would have thought we would have learned our lesson after that, but those conditions of easy money, not too long after from the 90s arrived in the early 2000s and brought us the global financial crisis. That was a completely debt-driven, lack of any kind of common sense credit underwriting phenomenon.